Money Power Fraud presents the Libor Scandal, Technical Collusion in Global Interest Rates. Chapter 1, Executive Exposure, Price Fixing at the Core of Global Finance. Libor sat at the center of global capital markets. It was embedded in corporate loans, adjustable rate mortgages, interest rate swaps, sovereign-linked instruments. At its peak, it influenced over $300 trillion in financial contracts. This was not a niche benchmark. It was a foundational pricing layer. Every day, institutions relied on it to determine borrowing costs, derivative valuations, risk exposure. The assumption was simple. Libor reflected real interbank lending conditions, but the rate was not transaction-driven. It was submission-driven. Banks reported what they believed they would pay, not what they actually paid. This distinction was critical. It introduced a structural vulnerability. The input could be influenced without immediate detection. No capital needed to move. No trade needed to occur. Only a number needed to be submitted. That number propagated globally. A fractional adjustment, just a few basis points, could shift derivative portfolios by millions, loan payments across entire economies, balance sheet valuations. This created asymmetric leverage, small input manipulation, large financial consequence. The system assumed independence between submitting banks. In reality, those banks shared exposure, similar trading positions, similar funding pressures, similar reputational incentives. The environment was not adversarial. It was aligned. Coordination did not require formal conspiracy. It required shared incentive structures, what appeared as independent submissions, could converge into engineered outcomes. This is where the failure begins, not at the point of manipulation, at the point of design. The benchmark allowed self-reported estimates, no transaction verification, limited real-time oversight. It treated subjective input as objective data. That conversion from opinion to benchmark was the critical flaw. Once embedded, the rate became systemic infrastructure. Financial models assumed its integrity. Contracts depended on its stability. Regulators referenced it. Institutions priced around it. The system scaled trust without scaling verification. This created a paradox. The more widely Libor was used, the more dangerous its vulnerability became, because failure at the input layer propagated across the entire system. This was not a localized fraud. It was a control point inside global finance, and it remained exposed for years. Chapter 2, Structural Foundation, How Libor Was Supposed to Function. Libor was designed as a proxy, not for trades, for perceived borrowing cost. Each panel bank answered a single question. At what rate could you borrow unsecured funds? In the interbank market, the answer was hypothetical, not transactional. Every day submissions were collected across multiple currencies, multiple maturities, overnight, 1 month, 3 months, up to 12 months. The process followed a defined sequence. Step 1, each bank submitted its rate estimate. Step 2, the highest and lowest submissions were removed. This was intended to eliminate outliers. Step 3, the remaining values were averaged. The result became the official Libor fixing. This structure created an illusion of robustness. Trimmed averages suggested statistical integrity. Panel diversity suggested independence. But both assumptions were fragile because the inputs were not anchored to executed trades. There was no requirement to borrow funds at the submitted rate, to prove access to that rate, to reconcile submissions with actual transactions. The system operated on declared intent, not verified reality. This created a critical dependency. The benchmark depended entirely on the honesty of participants. There was no enforcement mechanism. At the point of submission, no real-time audit and no automatic validation, only post hoc review. And even that was limited. The architecture assumed banks would protect the integrity of the system because they depended on it. But those same banks also held positions sensitive to Libor movements, managed liquidity under pressure, controlled the inputs directly. The system concentrated 3 functions inside the same entities: rate contributor, market participant, economic beneficiary. There was no separation of duties. This is where structural fragility emerges. In most systems, control and exposure are separated. In Libor, they were unified. The benchmark was not externally observed. It was internally declared. And once declared, it became externally trusted. That conversion from internal estimate to global reference rate was the core structural leap. It transformed unverifiable input into contractual truth. The system did not require coordination to fail. It only required aligned incentives and unverified inputs. That condition was already present. Chapter 3, Incentive Distortion, Why Banks Manipulated Submissions. The system did not fail randomly. It failed predictably because the incentives were misaligned. Two pressure vectors shape behavior. First, trading exposure. Second, perceived credit strength. Start with trading desks. Large banks held derivative portfolios directly tied to LIBOR movements, interest rate swaps, futures, structured products. These positions were sensitive to small rate changes. A 1 basis point shift could move portfolio value materially. Across scale, this meant millions in P&L impact. Daily, this created directional preference. Traders did not need large movements. They needed controlled adjustments, and the input was accessible. Submission desks sat inside the same institutions. This created a feedback loop. Trading desk defines exposure. Submission desk adjusts rate input. Benchmark moves. Position benefits. No external coordination required, only internal alignment. Now layer in funding perception. During stable periods, incentives were profit-driven. During crisis periods, incentives shifted to survival. Higher submitted rates implied difficulty accessing funding, counterparty risk, liquidity stress. Markets interpreted elevated LIBOR submissions as signals of weakness. Banks responded accordingly. They suppressed submissions not to reflect borrowing cost, but to maintain confidence. This introduced a second distortion layer. The rate no longer reflected market conditions. It reflected reputational positioning. Lower submissions signaled strength. Even when funding costs were rising, this created divergence. Reported reality and actual funding conditions moved apart. And the system amplified that divergence because every bank faced the same pressure. No institution wanted to appear weakest. So submissions converged downward, not through explicit agreement, through shared incentive, and this is critical. The manipulation did not begin as coordinated conspiracy. It emerged from structural alignment, each participant optimizing within the same flawed system. Over time, the communication formalized the behavior. Traders began requesting specific submissions. Submitters began accommodating those requests. Patterns became repeatable, then normalized. At that point, distortion was no longer incidental. It was operational. The benchmark became a tool, not a measurement. And once the incentive structure stabilized, the outcome became consistent. The rate would reflect what institutions needed it to be, not what the market dictated. This is where system integrity collapses, not when rules are broken, when incentives make breaking them rational. Chapter 4. Mechanism of Manipulation, How the Rate Was Engineered. The manipulation did not require technical sophistication. It required control over a single input, the daily submission. Each morning, designated submitters provided rate estimates. These individuals operated inside treasury or money market desks. They had authority and discretion. That discretion became the control point. The process followed a repeatable pattern. Step 1. Trading desks assessed exposure. Positions were mapped against potential LIBOR movements. Upward pressure, downward pressure. Desired direction was defined. Step 2. Communication occurred internally. Traders contacted submitters directly. Requests were explicit. We need a lower fixing today. Keep it high for the next tenor. These were not abstract signals. They were operational instructions. Step 3. Submission adjustment. Submitters altered reported rates. Not drastically. Precision mattered. Small deviations avoided detection, while still influencing the aggregate. Step 4. Benchmark calculation. Outliers were removed. Remaining submissions averaged. Adjusted inputs remained inside the trimmed range, which meant they directly influenced the final rate. This is critical. The system's outlier removal did not eliminate manipulation. It protected it. As long as submissions stayed within consensus bands, they passed through the calculation unchanged. The manipulation was embedded, not visible. Now extend this across institutions. Multiple banks operated under similar incentives. Over time, informal coordination emerged. Traders across firms communicated, aligning expectations, sharing directional bias, reinforcing submission patterns. This created synchronized influence, not through centralized control, through distributed alignment. The result, the benchmark moved predictably, within narrow controlled ranges. No single submission needed to dominate. Marginal adjustments across multiple contributors produced cumulative effect. Now layer crisis conditions. During liquidity stress, a second manipulation channel emerged. Banks suppressed submissions to avoid signaling funding distress. This was not trader-driven. It was institutionally defensive. Treasury functions intervened. Submissions were lowered relative to actual borrowing cost. This created systemic underreporting. The rate appeared stable, while funding markets deteriorated. This distortion masked risk. Counterparties relied on LIBOR as a proxy for interbank health, but the signal was compromised. The mechanism required no external breach, no falsified documents, no fabricated transactions, only controlled estimates submitted within accepted parameters. This is what made the system vulnerable. Manipulation did not violate the process. It operated inside it. And because the system validated form, not substance, the engineered rate was accepted as reality. Chapter 5: Institutional Blind Spots, Regulatory and Structural Failures. The manipulation persisted because oversight was misaligned, not absent, misapplied. Regulators monitored outcomes. They did not validate inputs. This distinction defined the failure. Start with the core weakness. There was no requirement to anchor submissions to executed transactions. Banks were not required to prove actual borrowing at submitted rates, access to unsecured funding at those levels. The benchmark operated on unverifiable estimates. This removed the primary control mechanism, transaction-based validation. Without that anchor, the system could not distinguish market signal from institutional preference. Now consider supervisory fragmentation. Libor operated globally, but oversight was distributed. National regulators, central banks, industry bodies. No single authority controlled the full system. Responsibility was diffused. Each regulator assumed. Another layer was validating integrity. No layer was. This created a governance gap. Next, audit timing. Reviews were retrospective. Submissions were examined after publication, not before acceptance. This meant manipulation was already embedded before scrutiny occurred. And because adjustments were small, they appeared statistically normal. No immediate anomaly triggered intervention. Now layer institutional trust. The system assumed large banks would not compromise, a benchmark they depended on. This assumption replaced enforcement. Reputation was treated as a control mechanism, but incentives overrode reputation because the gains were immediate and detection probability was low. Now examine information asymmetry. Submitters operated inside institutions, regulators operated outside. Internal communications were not visible in real time. This allowed direct trader influence, coordinated messaging, repeated behavioral patterns, all without external visibility. The control environment lacked real-time surveillance, communication monitoring, behavioral analytics. Detection relied on whistleblowers, and post-event investigation. Finally, design blindness. The system was not stress-tested for incentive distortion. It was built for normal conditions. Under stress, behavior changed, but the system architecture did not. It continued to assume honest reporting, independent judgment, market-aligned incentives, none of which held. This is the defining failure. The system did not collapse. Because rules were ignored, it collapsed. Because rules did not account for rational behavior under pressure. The oversight framework validated structure. It did not validate truth. And in that gap, manipulation became sustainable. Chapter 6: Escalation Phase. Crisis conditions expose system vulnerability. The system remained stable as long as market conditions were stable. Distortion existed, but it was contained. The 2007 to 2008 financial crisis changed the environment. Liquidity tightened, interbank lending contracted, trust between institutions deteriorated, banks became uncertain about counterparty solvency. This had immediate implications. Actual borrowing costs increased, access to unsecured funding declined. In a functioning benchmark, Libor should have risen sharply, reflecting stress. But submissions did not follow proportionally. They remained artificially compressed. This created divergence. Reported rates and real funding conditions moved apart. The gap widened under pressure. Now examine the incentive shift. During normal conditions, manipulation targeted trading advantage. During crisis conditions, manipulation targeted survival. Higher submissions signaled weakness. Weakness triggered increased scrutiny, counterparty withdrawal. Funding constraints. Banks avoided this signal that they lowered submissions, not to influence derivatives, but to protect perceived stability. This behavior was rational. Individually, systemically, it was destabilizing because the benchmark lost informational value. Market participants relied on Libor to assess banking system health, but the signal was distorted. Risk appeared lower than it actually was. This delayed reaction. Counterparties continued exposure based on inaccurate data. Now consider feedback loops. Lower submissions reinforced, illusion of liquidity, suppressed volatility signals, delayed pricing adjustments. This created systemic mispricing across derivatives, credit instruments, structured products. The longer the divergence persisted, the larger the embedded risk became. Now layer coordination effects. All major banks faced similar pressure. No institution wanted to appear weakest. Submissions converged, not toward truth, toward acceptable perception. This created artificial consensus. The trimmed average mechanism reinforced this effect because clustered submissions passed through unchallenged. The system interpreted alignment as accuracy when it was actually synchronized distortion. At this stage, the benchmark no longer measured markets, it managed optics, and because Libor was embedded. In global financial contracts, this distortion propagated into pricing models, into risk systems, into capital allocation decisions. The escalation phase did not introduce the flaw, it exposed it. Under stress, the system revealed its true dependency, trust without verification. And once that trust decoupled from reality, the benchmark lost its function, not visibly, but structurally. The collapse had already begun. Chapter 7, Trigger Event, Detection and Exposure. The system did not self-correct. It was exposed externally. Initial signals came from market participants. Observed anomalies. Libor remained stable. Credit spreads widened. Funding markets showed stress. The divergence was measurable, but not immediately explained. This triggered scrutiny. Analysts began comparing reported Libor against observable transaction data, including repo markets, commercial paper rates, credit default swap spreads. The relationships did not align. This created a hypothesis. The benchmark was not reflecting real conditions. At the same time, internal signals emerged. Whistleblowers flagged irregularities. Concerns centered on submission consistency, communication patterns, rate clustering. These signals moved to regulators. Investigations began. Now the critical shift. Focus moved from outcomes to inputs. Regulators requested submission records, internal communications, trader interactions. What they found changed the frame. Email trails revealed direct rate requests, acknowledgement of manipulation, repeated coordination. Chat logs confirmed specific basis point targets, timing alignment, cross-desk communication. This was not isolated behavior, it was systematic. Across institutions, across time, the manipulation was not occasional. It was embedded in daily operations. Now the evidence threshold was met. The issue was no longer theoretical. It was provable. Regulatory bodies escalated. Formal investigations, multi-jurisdiction coordination, enforcement actions. Institutions were compelled to respond. Internal reviews began. Compliance failures were identified. Control frameworks were reassessed. Public disclosure followed. This is the critical moment. Not when manipulation occurred, when credibility was lost, because the benchmark's value depended entirely on trust. Once inputs were proven unreliable, the output became unusable. Markets reacted accordingly. Participants questioned contract pricing, historical valuations, risk models, legal exposure expanded. If Libor was manipulated, then any contract referencing it was potentially mispriced. This introduced systemic uncertainty. Now the transition begins from hidden distortion to acknowledged failure, and once acknowledged, the system could not continue unchanged, because the core assumption that submissions reflected reality had been invalidated. Chapter 8, Collapse of Credibility, Market and Legal Consequences. Once manipulation was confirmed, the benchmark lost functional integrity, not gradually, immediately. Libor was no longer treated as an objective reference rate. It became a compromised input. This had direct consequences. Start with contract exposure. Libor was embedded in interest rate swaps, syndicated loans, mortgage products, corporate credit facilities. These contracts relied on accurate benchmark pricing. If the rate was distorted, cash flows were miscalculated. This introduced transfer of value between counterparties, mispriced risk, incorrect hedging outcomes. Even small deviations mattered. Across trillions in notional exposure, basis point shifts scaled materially. Now consider valuation systems. Financial models used Libor as a discounting and projection input. If the input was unreliable, model outputs were compromised. This affected balance sheet valuations, risk-weighted asset calculations, capital adequacy metrics. The issue extended beyond trading. It impacted reported financial condition. Next, legal liability. Regulators initiated enforcement actions. Findings included intentional rate manipulation, inadequate internal controls, failure of supervisory frameworks. Penalties followed. Major institutions faced multi-billion-dollar fines, criminal investigations, individual prosecutions. But fines addressed behavior, not system damage. Now examine counterparty trust. Financial systems operate on reliable benchmarks, predictable pricing mechanisms. Once Libor was compromised, confidence deteriorated. Institutions questioned historical transactions, ongoing contract integrity, counterparty disclosures. This increased friction. Liquidity depends on trust. Trust depends on transparency. Both were degraded. Now layer systemic risk. The benchmark was not isolated. It was interconnected. Distortion propagated into derivatives markets, credit pricing, funding structures. This created uncertainty in multiple layers simultaneously. Markets responded by increasing spreads, reducing exposure, repricing risk. Finally, reputational impact. Global systemically important banks were implicated. This shifted perception from isolated misconduct to systemic governance failure. The issue was no longer, did manipulation occur? It became, can core financial infrastructure be trusted? At that point, the benchmark could not be repaired in place because credibility, once broken at the input level, cannot be restored through adjustment alone. The system required replacement, not reform. Chapter 9. Aftermath, transition away from Libor. Once credibility was lost, continuation was no longer viable. The benchmark could not be repaired incrementally. It required replacement. Regulators initiated a coordinated transition. The objective was clear: remove subjectivity from benchmark construction, replace estimates with observable transactions. This marked a structural shift from opinion-based inputs to data-anchored rates. New benchmarks were introduced. In the United States, SOFR, Secured Overnight Financing Rate, based on overnight repo transactions, collateralized lending, high-volume observable trades. In other jurisdictions, SONIA, UK, Euro-STR, Eurozone, TONA, Japan. Each followed the same principle, transaction-first architecture. This addressed the core flaw. Inputs could no longer be declared. They had to be executed. Now consider transition complexity. Libor was embedded in legacy contracts across loans, derivatives, structured products. These contracts required renegotiation clauses, fallback provisions, rate conversion mechanisms. This introduced operational risk. Institutions had to reprice exposures, adjust models, update systems. The transition was not instantaneous. It occurred over multiple years, with phased deadlines. Now examine structural improvements. New benchmarks incorporated high transaction volume, transparent methodologies, regulatory oversight alignment. This reduced manipulation surface area, input discretion, information asymmetry, but it introduced trade-offs. Transaction-based rates reflect actual market conditions, including volatility. Libor, by contrast, smoothed conditions through estimation. The new system increased accuracy, but reduced artificial stability. Now consider governance. Oversight became centralized. Clear accountability structures were defined. Benchmark administrators were subject to regulatory standards, audit requirements, data verification protocols. This closed the prior gap, where global benchmarks operated under fragmented supervision. Finally, decommissioning. Libor was phased out. Tenors were discontinued in stages. Market participants were forced to migrate, not by preference, by necessity. This marks the key outcome. The system did not evolve. It was replaced because the original design could not support incentive integrity, data verification, systemic trust. The lesson is structural. If a benchmark relies on unverifiable input, it will eventually fail, not under normal conditions, under stress. And once failure is exposed, replacement becomes unavoidable. Chapter 10. Systemic Interpretation. What Libor reveals about financial infrastructure. Libor was not an isolated failure. It was a case study in system design risk. The benchmark did not fail because of misconduct alone. It failed because misconduct was structurally viable. This distinction matters. Most financial systems assume participants will act within rules. Few systems are built assuming participants will optimize around them. Libor exposed that gap. Start with the core principle. Any system built on self-reported inputs contains embedded manipulation risk. If those inputs influence financial outcomes, they will be influenced, not occasionally, systematically. Now extend this. Financial infrastructure relies on benchmarks, models, reported metrics. Each serves as a decision input. Each carries embedded assumptions. If those assumptions include honest reporting, independent behavior, aligned incentives, then the system is exposed because incentives are rarely neutral. Libor demonstrated control of input equals control of output, and in financial systems, output defines value. This creates leverage, not capital leverage, information leverage. Small influence at the input layer produces large effects downstream. Now consider scaling. The more widely a benchmark is used, the greater its systemic importance, but also the greater the consequence of distortion. Libor scaled globally. Its failure propagated globally. This is a key insight. Systemic risk does not require complex instruments. It requires a widely trusted reference point with a hidden vulnerability. Now examine institutional behavior. Participants did not need to conspire formally. They needed aligned incentives. When multiple actors face similar exposure, similar pressures, and similar constraints, behavior converges. This creates coordination without explicit agreement. Libor was an example of emergent collusion, driven by structure, not necessarily design intent. Now consider regulatory architecture. Oversight focused on compliance with process, integrity of outputs. It did not interrogate validity of inputs. Incentive structure behind submissions. This created blind spots because the system appeared compliant while being fundamentally distorted. Finally, trust as infrastructure. Financial systems rely on trust, but trust is not a control mechanism. It is an assumption. When systems scale globally, assumptions must be replaced with verification. Libor scaled trust without scaling validation. That is the systemic failure. The broader implication is direct. Any financial system that converts subjective input into objective output, embeds that output into contracts, scales without verification, will eventually experience distortion, not as an anomaly, as a function of design. Libor did not break the system. It revealed how the system breaks. Chapter 11, Operational Implications, where this risk still exists. The Libor failure did not remove the pattern, it exposed it. The same structural vulnerability exists in multiple modern systems. Start with a simple filter. Wherever inputs are self-reported, model-derived, thinly traded, internally generated, there is exposure. Now apply that filter. Private market valuations and assets are marked based on internal models, not continuous market transactions. Valuations depend on assumptions, comparable selection, discount rate inputs. These can be adjusted. Small changes produce large valuation shifts, especially in illiquid environments. This mirrors Libor. Subjective input becomes reported reality. ESG and non-financial scoring systems. Scores are derived from disclosed data, self-reported metrics, methodology weighting. Incentives exist to optimize reporting, not necessarily underlying performance. This creates score inflation without structural change. Again, input control drives output perception. Internal risk models. Banks and funds use proprietary models to estimate value at risk, stress scenarios, capital requirements. These models depend on volatility assumptions, correlation structures, historical inputs. Under pressure, parameters can be adjusted, not falsified, calibrated. The outcome, risk appears reduced, capital requirements decline. This is structurally identical. Model input, right arrow, risk output, right arrow. Regulatory consequence, illiquid credit and structured products. Pricing depends on dealer quotes, model extrapolation, sparse transactions. When markets are thin, price discovery weakens. Institutions influence marks within acceptable ranges. This creates stability signals that do not reflect underlying risk. Benchmark construction in emerging markets. Some benchmarks still rely on limited transaction data, panel-based inputs, estimation frameworks. Where liquidity is low, subjectivity increases. The same conditions reappear, unverified inputs, inside trusted systems. Now identify the common structure. Each system contains a reference output embedded in financial decisions, derived from flexible inputs, controlled by interested parties. This is the Libor pattern, not historical, recurring. Now consider detection difficulty. These systems rarely fail in stable conditions. Because inputs remain within expected ranges, outputs appear consistent, no immediate contradictions emerge. Failure appears under stress. When liquidity tightens, assumptions break, incentives intensify. At that point, input distortion increases, output reliability decreases, and the gap becomes visible. Finally, operator implication. You are not exposed because systems exist. You are exposed if you rely on them without interrogation. The correct question is not, what does the benchmark say? It is, how is the benchmark constructed? If the answer includes estimation, discretion, internal control, then the exposure is structural and it remains active. Chapter 12, Strategic Defense, How to Identify and Avoid Benchmark Risk. Benchmark risk is not eliminated, it is managed. The objective is not avoidance of all systems, it is identification of where systems can be influenced. Start with the primary diagnostic. Input integrity test. Ask one question. Is this benchmark derived from executed transactions or declared estimates? If the answer is estimates, risk is elevated. If inputs are discretionary, they are influenceable. Incentive alignment analysis. Identify who controls the input, then identify their exposure. If the same entity submits data and benefits from the outcome, there is structural conflict. This was the Libor condition. It exists in other systems. The higher the economic sensitivity, the stronger the incentive to influence. Verification layer check. Determine whether inputs are independently audited, cross-referenced with external data, validated in real time. If verification is delayed or absent, then distortion can persist undetected. Post-event audits do not prevent manipulation. They only document it. Transaction depth assessment. Evaluate the underlying market. Is there high volume, continuous trading, transparent pricing, or sparse transactions, intermittent liquidity, model-based extrapolation? Low depth increases subjectivity. Subjectivity increases manipulation surface area. Dispersion analysis. Compare the benchmark to adjacent market indicators. Examples: credit spreads, repo rates, funding indices. If divergence appears, and investigate the cause. Sustained divergence signals. The benchmark may not reflect reality. Stress behavior testing. Ask how the benchmark behaves under market stress. Does it move with volatility, reflect tightening liquidity, or remain artificially stable? Lag observable conditions. Stability during stress is often a warning signal, not a strength. Governance structure review. Identify who administers the benchmark, who sets methodology, who enforces compliance. If governance is fragmented or is unclear, accountability weakens. Centralized oversight reduces ambiguity. Model dependency mapping. Determine where the benchmark feeds into. Valuation models, risk systems, contract pricing. The more dependencies, the higher the systemic exposure. A compromised input scales across all connected outputs. Practical mitigation strategies. Prefer transaction-based benchmarks. Use multiple reference rates where possible. Apply independent pricing sources. Stress test models with alternative inputs. Monitor divergence continuously. Reduce reliance on single-point benchmarks. Operational rule. If the input can be influenced, the output must be questioned. If the output is trusted blindly, exposure is unbounded. Strategic positioning. Do not treat benchmarks as truth. Treat them as signals. Signals require validation. The failure in Libor was not access. It was assumption. Participants assumed integrity because the system was widely used. That assumption created exposure. Final principle. You do not eliminate benchmark risk. By selecting better benchmarks alone, you reduce it by understanding construction, analyzing incentives, and verifying inputs continuously. Anything less recreates the same conditions under a different name. Chapter 13. Closing framework. The illusion of objective markets. Libor was treated as a neutral reference point. It was not. It was a constructed signal, derived from institutional input, trusted as market truth. That transformation from estimate to infrastructure is where the risk resides. Financial markets rely on abstraction, rates, indexes, models. These are not reality. They are representations of reality, and representations can be shaped. The Libor system did not fail because manipulation was possible. It failed because manipulation was invisible within accepted structure. This is the critical insight. A system does not need to be broken to be compromised. It only needs to allow influence without detection. Now extend this beyond Libor. Modern financial systems are layered. Each layer depends on data inputs, methodologies, assumptions. When those inputs are subjective, controlled, incentive linked, the output becomes conditional, not objective. This creates a false confidence. Participants believe prices reflect markets, benchmarks reflect conditions, models reflect risk. But in reality, they reflect inputs, and inputs reflect incentives. This is the inversion. Markets are assumed to drive signals, but signals often drive markets. When a benchmark is accepted, it becomes a coordination mechanism. Participants align around it. Contracts depend on it. Models embed it. At that point, challenging it becomes costly, so it persists, even when flawed. This is why failure is delayed, not because systems are strong, because they are embedded. Libor persisted for years, with known inconsistencies, because replacing it was operationally complex. That complexity protected it, until exposure exceeded tolerance. Now define the broader framework. Every financial system exists across three layers. Layer 1, input, data, submissions, assumptions. Layer 2, transformation, calculation, aggregation, modeling. Layer 3, output, benchmark, price, risk metric. Most participants focus on Layer 3. Very few interrogate Layer 1. But control exists at the input, not the output. This is where leverage resides, and this is where risk concentrates. The Libor Scandal did not introduce this structure. It revealed it. The implication is direct. Do not assume objectivity, because a system is widely used. Do not assume accuracy, because a number is standardized. And do not assume integrity, because institutions participate. That those are adoption signals, not validation. Final position. Financial systems do not fail. When they are attacked, they fail. When their assumptions are untested. Libor was not an anomaly. It was a demonstration of how global systems can be influenced through controlled inputs, under aligned incentives, without immediate detection. That condition still exists. The only difference is where you choose to look.